out in front with 35.
Friday, January 7th.
Tom Gallagher is the
Wall Street Week special, 10 to 11. Friday, January 7th.
So, he covers the nation's capital for Lehman Brothers. Tom, what will happen to President Clinton?
Barring new revelations or a change in public opinion, I think the president will not be removed by the Senate. He'll serve out his term, and his leadership ability will be impaired, but I think he'll serve out his term. Now, I really think that's what's important for the markets now, is that they know the outcome. They're quite confident of the outcome of that. Whether or not it's a short trial or a quick trial doesn't really matter. I think just the markets are worried about whether or not to be removed, and I don't think that's in the cards.
Think he gets censured?
Well, he probably will be, although I think the politics in that are a little bit trickier than the current discussion suggests.
How do you account for the fact that in our poll, so many people think censure, which they expect, is not severe enough punishment, but at the same time, an overwhelming majority say he's done a great job as president?
I think the most interesting poll result in there from a political point of view was the finding that 86% of the people are optimistic about their personal future. That's an extraordinary level of optimism, and so incumbents are going to do well across the board. That's why the president's popularity is so high, and I think that's why Congress has been reluctant to remove such a popular president. It's why Congress's popularity moved up a little bit. It's why the governors are doing so well. The economy is the most important variable in politics. On the other hand, if the economy turns, the political dynamics in Washington will change quite a bit.
Poll says, not surprisingly, leading candidates for next year, Al Gore, George Bush. Do they have it sewed up?
I don't think they have it sewed up. I don't think any politician is going to act that way. It's going to be very hard for any other Democrat to unseat a sitting vice president seeking the nomination. So it's going to take a real bad stumble for Gore. I think Bush may be less of a certainty. He's kind of the internet stock in the Granville portfolio, if you will. There are high expectations for him, but he doesn't really have a track record, so he's maybe more likely to stumble. So it's interesting to think of who might take advantage of a stumble by Bush.
A couple of quick legislative questions. Any action this year on Social Security?
They'll try hard, but I don't think they're going to do it. Even without the partisan rancor over the impeachment issue, there are some extraordinarily difficult issues there. And it's unfortunate because this is really an ideal time to try to address Social Security. But I think the odds are against it.
So they don't do it this year, or they're off for 2 years?
I think it's probably off for more than 2 years. Could be waiting for another 4 or 5 years.
Is the budget surplus for real?
It's for real. We had one last year. We're going to have another one this year. And I think the question for the bond market is that surplus going to be used to retire debt, which would be good for bonds, or is it going to be used for other purposes? And I think everybody wants to use it for something, but they won't be able to agree, so stalemate will probably be good for the bond market this year.
So the news is more of the same?
Yeah, I think it is. I think it is. Unless the economy changes, I think that could be the big surprise.
Tom Gallagher, thanks very much.
Thank you.
Let's turn to what our poll revealed about people's views on investing in 1999. As usual, Americans are relatively cautious about the prospects for stocks, with just 9% expecting them to be much higher. But keep in mind that the amateurs have been as faulty as most of the pros in predicting the unprecedented surge that has sent stocks soaring in each of the past 4 years, none of which was widely expected by those polls. But the money keeps on coming. 35% say they'll buy individual stocks this year, up 4% from a year ago, and the highest number we've ever reported. 20% say they'll buy smaller stocks, while 15% prefer to stick with the big blue chips. Deflation concerns may be in the headlines, but most Americans are from Missouri on that one. 42% say interest rates will be higher a year from now. Only 8% see them going lower. Bonds are notably less favored than stocks, with just 18% saying they plan to buy Treasury, corporate, or municipal bonds this year. Should you be buying stocks or bonds this year? And if so, which ones? Let's ask my next three guests. Joseph Battipaglia is Chief Market Strategist for Grunthal & Company. Chuck Cloud directs investment strategy for Merrill Lynch. And Arden Armstrong runs $1 billion in small and medium stock funds for Miller, Anderson, and Sherrod. Joe, you have long been bullish on the stock market, which means you have long been correct on the stock market. But is it possible that the end of the long bull market at last is in sight?
I don't think so. Only two things will derail the bull market, and that is the advent of a recession or the advancement of an inflationary cycle. Neither of those are in the cards for 99, so I look for another big double-digit year.
Chuck Cloud, you've taken a more cautious view. You clearly don't look for another big double-digit year, is that correct?
Look,
we think it'll be somewhat more muted. Where interest rates bulls, but profits bears. So lower interest rates we think will help. But like 1998, the long treasury outperformed the average stock by quite a range, and we suspect we'll see the long treasury again being a pretty competitive instrument.
Arden, what's your view?
Well, we don't necessarily try to forecast the stock market in our job. We just try to pick good stocks. But I would say on balance, I would tend to be bullish because of the liquidity, the disinflation, and the overall good economy that we're experiencing.
Joe, where would you put your money now?
4 areas: transportation stocks, financials, pharmaceuticals, and technologies. They've got us to this point. They've got certainly much more to go in 1999.
Any of those issues have names?
In fact, they do. Certainly Intel, Microsoft, Cisco, Lucent in the technology side, Texas Instruments included. Pharmaceuticals, big names, Merck, Johnson & Johnson, Pfizer with Dews, Plow. Transportation, Southwest Airlines is a terrific name. And of course in financials, I think American Express. And I'd like to play JP Morgan as well as a bank on the mend.
I can't write that.
Chuck has already hinted that he's fond of that 30-year Treasury bond. How do you look on it?
Well, I think he's right about that. In fact, the real return to the investor is going to be there once again in 99. It just won't have the same dynamic performance as it did the year before because we now are at 5% on the long bond.
Chuck's caveat was that we couldn't expect earnings to continue increasing at such a rapid rate. What's your expectation on earnings?
Well, I think that there's 2 parts to the market. Those companies and industries that do have double-digit growth and will show it again. Technology, of course, is one of them. And then basic industries that are sensitive to price and foreign competition that'll struggle once again. But their saving grace is that they'll consolidate in 1999. There'll be a tremendous amount of takeover activity, making that set of stocks work almost as well as the growth story.
Chuck, am I right that your number 1 pick would still be the Treasury bond?
Number 1 pick would still be the Treasury bond. Price plus yield, we think will give you good double-digit returns. In the stock market, we like groups that are generating excess cash. To us, that would be some of the utilities, both telephone and electrics, and the cable, media, entertainment complex. We think those will probably be the 2 best performing sectors in 1999.
Let me ask you the same pertinent question. Any of those stocks have names?
Well, this week we put telephone AT&T on our focus list. And upgraded GMH as well. Well, the opposite way around. GMH on the focus list and AT&T was upgraded. In the cable area, we just like Time Warner, Comcast, and quite a number of stocks. And we think most of the entertainment media stocks will do fairly well this year.
Why? What's so good about them this year?
Well, they're both cash generators. The cable sector was investing heavily and borrowing heavily to do it. Ended up with very leveraged balance sheets. Now you're over the hump. You're starting to generate excess cash. And as you start to liquidate debt, that just gives you a leveraged impact on earnings. We see the same thing happening in a number of utility sectors. This massive wave of consolidation, we think, will start to slow investment in the telecom sector, and that will help earnings for an awful lot of telecom service providers.
What do you hate? What would you stay out of?
We still think the basic cyclical sector, it had a bounce this week. And our sense is that commodity prices will not be moving up, and that there's probably some danger in capital spending. Capital spending will start to slow, and that would keep the basic commodity and traditional capital goods sector of the market, we think, under a bit of a cloud.
Arden, given your penchant for smaller and medium-sized stocks, those have not been the market's favorites of late. These fellows just mentioned a few more big stocks. Are they behind the curve? Are smaller stocks going to make it this year?
Well, I think it's been right to favor large cap stocks, and 99 may be different in that we might have a chance to produce better earnings growth out of small cap stocks than large cap stocks. We also like the telecom and media area because of the ability to produce good earnings growth, and some smaller cap names that we like there in the cable sector, Adelphia, which is a smaller cap cable company, ought to perform pretty much like the large cap cable stocks. The smaller cap telephone companies probably perform pretty much in line or maybe better than the large cap telephone companies. So it's different on a group by group basis.
In the great war between growth stocks and value stocks, how do you come down?
Well, we're growth investors. The 2 funds I run are small cap growth and mid cap growth. And we've had a wonderful growth stock environment. And as long as you see low commodity prices, low inflation, poor profit growth overall in the economy, investors will be looking for profit growth, and they'll be willing to pay more for those companies that can produce profit growth. So we do think it could be a good growth stock environment for the next couple of quarters.
The renewed popularity and leadership of smaller companies has been among the most predicted and least seen events of this decade. What's going to change that?
Well, small cap stocks have been cheaper than people thought they should have been for several years now. And that doesn't really seem to be enough to get them going. I think what you really need to do is to have a combination of inexpensive stocks coming off of a bear market and see better earnings growth in 1999. And if you get those, you already have two of those factors. If the third one comes through with better earnings growth, you'll see, I think, a rotation in leadership to the smaller cap stocks.
Joe, since your analysis seems to be mostly more of the same, is that also your forecast for the economy?
I think the economy is going to have some surprising twists. It'll be better than most think, and the first 9 months will suffer what I call the reverse year 2000 problem, and that is we will accelerate spending. Businesses will make decisions earlier to get it all done before we come to the new millennium. So I think the economy is going to surprise with some positive, strong performance at or around 3% through the first 9 months of the year.
Clearly, Chuck, you want to knock that one down, don't you?
Well, investment has been driving the economy. It's been growing 4 times as fast as consumption, and it's been the engine of jobs growth. And investment is where we think we'll start to see some weakness. There's already signs that backlogs in the non-defense capital goods sector are slowing here a bit. So our sense is there's enough strength now to carry the economy in the first quarter or so. As the year goes on, we think it will slow, and as it does, we think the yield curve will come down.
And do you think that year 2000 problem is going to have an impact?
At the margin, it will. There's probably some upfront spending that's going on right now. We are beginning to see some deceleration in technology equipment as well. Our sense is that all of this could combine to slow the economy later in the year.
Barton, you said you didn't waste a lot of time on stock market forecasting. How about economic forecasting?
Well, we don't do much economic forecasting, but I do think the Y2K problem could have an effect in the coming year. And we've done a lot of thinking about how that will affect individual stocks. And just for example, we like technology hardware for the first half of the year at least better than software stocks.
Give me an example, too.
Well, in technology hardware, we like Apple. We like a disk drive company called Maxtor. And we own some internet stocks like MindSpring and At Home. So we've really tried to stay away from, though, the application software companies because we think that upgrade cycle is largely behind us. And companies will want to freeze their software going into the 1999, make sure it works. They'll be spending their money on
How
hardware.
about the internet? Is that an area you're staying away from?
No, not at all. We've actually done very well by not staying away from internet stocks. And right now we have quite a few that we like. Ticketmaster Online City Search is one that we own. MindSpring is an internet service provider.
If you'd been polled in our survey, would you have said it was a truly revolutionary development?
Yes, I actually, a couple of years ago, sat down and tried to think to myself, well, is the internet a cellular phone or is it a CD radio? Decided it was a cellular phone, meaning it was important and it was going to be an important part of people's lives going forward, so we've been invested in internet stocks.
Thanks for being part of our lives tonight. Arden Armstrong, Joe Paglia, Chuck Clow. Thanks a lot. While interest in buying individual stocks is at a record high, there's been no diminishment of Americans' recent enthusiasm for mutual funds. 39% of those surveyed say they'll be buying funds this year. Don Phillips keeps a highly professional eye on the world of mutual funds as president of the Chicago-based mutual fund rating service, Morningstar. Don, what are the important new trends in mutual funds as we enter 1999?
I think one of the good trends in mutual funds is the fund industry is finally starting to pay some attention to taxation. You know, this has been an industry that the fund industry has ignored, or an issue that the fund industry has ignored for decades. And yet it's an issue that investors can't ignore. If they ignore it, they go to jail. So it's very important that the fund industry is finally taking this step.
You mean funds that routinely would take capital gains even when they were losing money in the year are now going to be a little more careful about that?
That's exactly right. There are a number of funds this year that had substantial losses that still made taxable distributions to shareholders. And because investors have had such success with funds over the last decade, a number of them now have very sizable amounts in these funds, and these distributions are very painful, and they're letting the fund companies know that, hey, pay a little more attention to this issue.
Are the funds pursuing the strengths in the market, in other words, are big blue chip funds growing in size and importance, or are they looking for the niches that have been less successful lately?
Well, that's one of the embarrassments, frankly, in the fund industry this year. I think all of the fund managers come out of this academic background where they've read the studies. They think that the way you beat the market is to own smaller, less rapidly growing companies. It's a small value. That's what the academics will tell you. And what they've done is they've systematically underweighted the great high-quality names in the market, and because of that, we've had huge percentages of active managers trailing the S&P 500 index in recent years.
Well, more than 90% over the last few years have not done as well as the S&P 500. Leading many people to ask the question, why don't I just buy an S&P 500 index fund and forget the rest? What's your answer?
Well, I think buying an S&P 500 index fund is a very good part of an investment program. I still will hold the candle that says that active management can and will at times run circles around the S&P, and I believe that active managers can add value. I'm just not certain that the fund industry has done as good, or made as good a case for that as they can.
What are some of your favorite funds for this year?
Well, the funds I like this year are actually kind of going against the trend. I still like the big, large cap growth companies. I think it makes sense to have those in the portfolio. But last year, our large growth category was up 36%. Our small value was down 7%. That's a 43 percentage point differential. So I think if you're looking for bargains, I would actually look to the area that the academics suggest for the long term, some of the small value, but I sure wouldn't give up on my large growth picks.
Give us 2 or 3 of your favorites in that area.
Well, I like Preston Athey's fund, T. Rowe Price Small Cap Value. I also like John Rogers' fund, the Ariel Growth Fund. And another fund I think is exceptionally well managed, the Skyline Special Equities by Bill Dutton. That's closed right now, but there's a Skyline Special Equities 2, which is available to investors.
How patient would investors have to be with these funds?
Well, I certainly wouldn't put all of my portfolio there. But what I'm suggesting is that I wouldn't say that I wouldn't have no part of my portfolio there. I think there's a potential that if we have a fairly strong economy and the earnings come through on these stocks, that you can see very good gains.
Finally, how about the rest of the world? Are international funds going to do better comparatively than they've done in recent months?
Hey, I think they will, and I think it makes sense for the investor to still make a place in their portfolio for international, but not just simply have international for the sake of having international, but to have international because there are great stock pickers who focus on those markets, who can find great companies that are domiciled outside the U.S.
Well, it's always a pleasure going around the world of mutual funds with you, Don. Thanks for coming.
Excellent.
There we do have to stop, with many thanks to all 10 of my truly extraordinary guests. They are, without exception, authentic leaders in their fields. People whose most impressive line is the bottom line. As you will have observed, they did not always agree. And the one guarantee I can offer you without qualification is that some of them will be wrong. Nobody bats 1,000 in this business, only the charlatans ever claim to. But the assembled advice we've heard in the past hour represents the thinking of some of those with the best batting averages in any league. And history suggests that 1 year from today, we'll be able to look back on some of the things we've heard tonight and have that rarest of human emotions, genuine gratitude. Let's hope so. And more important, let's hope that the exciting and challenging year ahead brings you everything you would wish in each of the areas we've discussed, from the White House to your house. After all, my friend, who deserves it more? I'm Rukeyser, and I'm awfully glad you came.
Rukeyser's 1999 Money Guide is produced in association with Rukeyser Television Incorporated by Maryland Public Television. Made possible by Prudential Securities. With more than 5,600 financial advisors nationwide, Prudential Securities provides solutions for a lifetime of investment needs.